Hey, thanks, Dave. Thanks, everyone, for tuning in this afternoon. We are going to be talking next about intraday retracements as they apply to the E-mini futures. So we'll be specifically talking about day trading setups, but all of the general principles for managing trades could easily be applied to other markets and other time frames. So how to profit from intraday retracements in the E-mini futures. Give you a little overview on what we're going to run through today. I really have three simple tools that are great for day trading. Nothing is proprietary, so it doesn't matter if you're on Thinkorswim, which is the platform I use, or if you're on TradeStation. You can apply the tools to any platform and really any of the markets. So I always like to go through, how to identify the trend so that we can identify when is the trend over and when is the trend changing, because those are the points that we're going to look to place our trades. And so everything sort of hinges upon those fundamentals. If you think of the basics of any football team, basketball team, they're coming into the new season, going into their baseball spring training, you're going to start with the fundamentals. So even if you don't necessarily trade in the same way as I do, as far as the way you're placing your orders, your entries, you might be able to take away some good tools or techniques rather to identify the trend or identify if we are in a range bound situation. And then we'll kind of wrap everything into how to get in a trade and then how to stay in those good trades as long as possible. And using some really simple trade management techniques, I'll show you how I get into the trade, manage a trade, and then exit the trade. So a little bit about me. Like Dave said, my name is Tim Racette. I blog over at eminimind.com, and by the name there, you can probably tell most of my trading is done in the E-mini futures. I've been trading since about 2006. In addition to day trading, I also do a fair bit of swing trading, but my kind of bread and butter day after day is really focusing on the morning session of the E-mini S&P futures. So I've had the pleasure to speak at a number of the festivals and Traders Expos, Money Show, and things like that, as well as contribute to the CME and Futures magazine. So I'm originally from the Chicagoland area, and I'm a big fan of getting outside and exploring the outdoors. So originally from Chicago area, but now living out in Scottsdale, Arizona. So when I'm not kind of in front of my computer, I like to get outside and ride my bike, get outside and hike. Spend a lot of time in the summer kind of traveling around and exploring some cool places across the country. And I spend a lot of time on my bike, which is coincidentally a great place to solve trading problems or come up with great ideas. If you can get outside away from your trading screen, you don't have to be consciously thinking about that strategy or that hang up that you're having. The biggest light bulb moments that I've had have come when I'm away from the screen, on a hike, on a walk around the block, out riding my bike, and I attribute a lot of my trading success to the athletic success that I've had sort of in tandem. There's a lot of things that I study in the athletic world that really parallel nicely with trading. And so, I like to use various analogies that relate to sports and other things outside of trading, but you don't always have to be focused and reading books about trading to make really big gains. And I like the phrase that Dan used as he was closing his presentation, talking about turning conscious competence, something that you're very deliberately focused on and having to put effort into, and doing that so many times, to developing mastery to the point where it becomes unconscious competence. So you understand it so well that you're just doing it in an unconscious way. So just like a basketball player would, set up for a free throw, consciously, they're doing that thousands and thousands of times. But when it comes to the high pressure game scenario, don't even have to think about it. And that's what we want our trading to be. And so that's why I really stress simplicity, to be honest, just keeping things as simple as possible to where you can execute it, you can replicate it, and it really doesn't matter if we're in a VIX 50 environment like we saw last March, or if we're in a VIX 20 environment that we're kind of situation we're in right now. So that being said, let's dive in and talk about day trading the E-mini futures. Oh, and I should also mention I am ASU Sun Devil, so that's kind of my tie to Arizona originally. So it was great to have access to the Chicago area for traders, for getting connected with Tom Sosnoff at Thinkorswim. Infinity Futures I've used for years as far as my trade execution platform. Worked downtown at the Board of Trade, and just being able to surround myself with so many experienced traders was a really good jumping off point for my trading. So now being in Arizona, it's certainly a lot nicer in the wintertime, but I do love Chicago in the summer. So let's run through a little bit about my trading style and my routine, and then we'll get into some of the specifics. So we're talking technical analysis, pretty simple. Most of my trades are anywhere from a few minutes to, an hour if I'm just trailing my stop in a position. Sometimes you get in the trade and it just kind of starts to run in your favor, and then it's at that point that you really don't need to micromanage it. It's just a matter of trailing your stop as long as it's going your way. So fairly short duration, but not really what I would consider scalping. That's my time window, 9:30 to 11:30 Eastern, kind of those first 2 hours of the day. And really that's all you need. I mean, if you can be more efficient with your time and focus in so that you're kind of putting up these constraints, if you continue to trade the rest of the afternoon and you end up taking a few losses, you end up revenge trading, all of a sudden that good day turns into a losing day, or that bad day turns into an even worse day. So the way I like to break it up is the morning session is where I do the day trading, and then kind of the last 15, 20 minutes of the day, that's where I manage any swing trade positions that I have on. So trying to keep them separate. That way I'm not, distracted with my day trades if I'm trying to manage a swing trade position at the same time. So rather than, I get the question a lot of, do you set a target for the day and try to hit that profit target? I don't do that for the reason that if there's nothing going on and I try to force something, typically it ends up costing you. And rather than trying to force something on a day where there's nothing going on, and then on a really good day, stopping after one winning trade because you hit your target already, I'd rather continue to trade on the good days and then stop trading when the market isn't that great. So less is more, as you can kind of tell, is my theme around simplicity. Really spending the time to educate yourself, focus on developing your mindset, using tools that you have, such as mastermind groups or various books that are out there. I think one of the one of the best books as of late is called Thinking in Bets by Annie Duke. It's not directly related or directly about trading, but she's a professional poker player. So there's a lot of great parallels in that book. And then just getting outside, getting away from the screen so you can internalize some of this stuff and really develop some clarity. And then the last thing to remember is that trading is just a means to an end. If you could do anything for the rest of your life, it probably wouldn't involve sitting in front of the screen all day long. If you kind of paint a picture of your perfect day, it very well likely might involve sitting in front of your computer for a couple of hours, but then you might want to go outside and get on the golf course or go swimming or play with your kids or be with friends and a host of other things. And so a lot of people, it seems, turn to trading because they want to quit their job in the 9-to-5 traditional sense, but trading is a lot of hard work, takes a lot of time, and it is certainly a lot less consistent as far as you go to work, you get a paycheck, you go to work, you get a paycheck. Your traditional 9-to-5 is not going to be mimicked in the trading atmosphere. So creating that long-term goal and that bigger picture is a really helpful way with, you do get stuck in a rut, or if you're going through a challenging week or two, you can keep that bigger picture in mind. So first thing I want to talk about is the tick chart. And when we're talking about a chart, most of the time folks are looking at a time-based chart, a 5-minute chart, a hourly chart, a 30-minute chart. And so a tick chart is just a slight variation on that time frame, to where instead of looking at a duration of time, we're looking at a number of transactions. And so a tick chart is based on a certain number of transactions. I like to use 512 as my number of transactions to the point at which a candle closes. So when you have a lot of bars forming, that means that there's a lot of transactions being taken place. And so the more bars that are forming really quickly means there's a lot more transactions, there's a lot more trading volume. If you look at that same tick chart after hours, it might take 5 minutes for a candle to form because there's just not a lot of activity going on. So there's a lot you can glean from the tick chart itself without having necessarily having volume on the chart. It's directly derived from price, and it looks essentially the same as a candle chart or a bar chart. It's just a different aggregate as far as time is concerned. So then what I like to do is pair that with a variation of the traditional candlestick. And again, nothing about this is proprietary. It's just a slight variation to the drop down that you have in your chart settings. So what I like to use is called a hakanashi, and it has a very similar look to the traditional candlestick, except the opening price of each new candle begins at the midpoint of the prior candle. So this is your traditional candlestick here on the left, and then this is the same chart, only with the hakanashi. So instead of the open of the candle, the opening price, be the actual open price where the candle price is at the open, it always pulls the midpoint of the prior candle for its opening price. And so you end up with these streaks, or these, a little bit cleaner looking trends. And so, yes, it's the same chart. You can pretty well tell that the chart is, in an uptrend here, and then a little bit of a downtrend, and then back in an uptrend. You can glean all that from the traditional candlestick chart, but when you're, looking at things developing in real time fairly quickly, I find that it's helpful for my eyes to clean up my chart, and I can make better decisions quicker without having to, sometimes squint or get a little bit too zoomed in on a traditional candlestick chart. So you don't have to use the colored bars with Thinkorswim. The default, I think, is green and red, but they could be filled and unfilled, black and white. It really doesn't matter. And so one thing that's really helpful for is it makes the trend change a little bit more apparent and obvious. So if you have green bars going up and all of a sudden you have some red bars, it's pretty clear that the trend has changed in the short term. So that brings us to kind of pairing these two together and combining the 512 tick chart with Hakanashi. And so you get this visual representation that makes it easy to spot those trend changes so that we can place trades at those areas. So traditional candlestick again on the left, not too difficult to tell that it's in a downtrend for a while and then we're moving sideways. But when you look at it with a Hakanashi, especially like the sideways movement, it becomes much clearer when you have, a couple green bars, couple red bars, couple green bars, couple red bars. That range becomes a lot clearer. And like some of the doji candles that, at the time might look like a reversal, well, with the Hakanashi, it's just going to look like a continuation of the trend. So let's talk a little bit about how you can identify the trend so that we can place trades. And then we'll get into what I'm looking for to place those trades. So basics, market structure, we kind of all know that the market doesn't go straight up and straight down. It kind of stair steps its way up. And so we've got, a series of steps or waves or undulations, whatever you want to call it. But all of this, pretty clearly driven by human behavior. Market goes up, you get selling, whether it's profit taking or shorting, then the market goes down. Those prices seem to be at a good value or on sale, so more buyers come in. People who put on shorts at those lower prices might end up underwater and have to cover their shorts, or as the phrase that's been passed around a lot lately, that short squeeze. And that buying of covering the positions ends up making the market go higher. So you have these undulations back and forth. And so all of that fear and greed that goes into the buying and the selling is what we're looking to understand so that we can capitalize on it. And so what makes the trend at the very basic level is higher highs and higher lows for an uptrend and lower highs and lower lows for a downtrend. And while that's super basic, a great exercise is to print out a 5-minute or a 15-minute chart of whatever market you're trading and go through and mark the highs and the lows and kind of identify, well, this high, how does it relate to the previous high? Well, this high is higher than the previous high, and go through and mark up the higher highs, higher lows, lower highs and lower lows. Then you can really begin to clearly identify when we're in an uptrend, when we're in a downtrend, and when there's no trend. And then you start to spot similarities to uptrends, downtrends, and range bound to where you can start to notice those characteristics almost in a subconscious level. And that can help determine or get a visual of, okay, we're at a inflection point and a likely spot for a trend change. So that's what it would look like if you just went through the chart, higher highs and higher lows, and just kind of relate them to the prior high and low. It's also really helpful to compare, print out a dozen trending days of their 15-minute chart to the ES and look at all of those side by side, and then print out a dozen range bound days on the ES and compare those side by side. And you make this conscious effort to pick out similarities, to break down the structure of what's happening. And then as time goes by, that conscious understanding starts to become unconscious. So now that we've understood, what makes up the trend, and I guess I'll back up add one more layer to that. It's at this point, if I were to kind of draw a vertical line from this lower low here, where when we're in a series of lower highs and lower lows, and then we transition to higher highs and higher lows, you have to take out the prior swing high. And it's at that point that the trend is changing. And so when you're in a downtrend and you take out a swing high, that's when the uptrend is sort of starting to take effect. And then you get a pullback, and that higher low solidifies the new trend. If you're in an uptrend, it's just the reverse. You take out a swing low, and that's what initiates the change in trend. Then you get a little bit of a rally, and that lower high solidifies the new downtrend. So when we talk about getting in a trade, what I like to do is wait for that break of the swing high or a swing low. And again, we're talking about intraday on the E-mini S&P, but you could take the same concept and use it on the daily chart. And in fact, I do use it on things like the SPY, the Qs, individual stocks, looking for swing highs and swing lows to be taken out to place trades in the same way, except instead of being day trades, they're swing trades because I'm looking at a bigger time frame. So looking for that swing high to be taken out, let's pretend that we were coming down, down, down on the left side of the chart, and then we take out that swing high. Okay, now it's time to start looking for a trade in the new trend. The other thing that's, a little bit bigger picture is if we're coming down, is there some sort of support level? Picture like below this chart, there's a big support level. Okay, so if we're coming down to that support level, I want to see a little bit of a bounce, take out that swing high so that I can then get into a long trade with the support that we're coming down to. So I'm always sort of looking a couple steps ahead. If the market is going crazy high, super fast, are we going to be bumping our head into resistance to where rather than chasing the market up, can I look for a potential short setup once we hit that resistance? So the first step is to wait for that swing high break if we're looking for a long. Then I just use a very basic 50% retracement tool to enter or as my entry point. And so it just looks something like this. And then using that 50% as the entry. So letting the market pull back roughly halfway, and then just putting my order, if I want to go long, I just put it, a tick or so above that 50% to get in the trade. And I don't put a ton of emphasis on the actual entry itself. Yes, there's structure to it, but I find it's more important to have a good understanding of the fundamentals to identify where you want to be active in trading and where you want to place trades. And whether you're getting in at a 50% or you're doing some kind of moving average cross, getting in the trade, that's kind of the easy part. And then so identifying is super important. Getting in the trade, yeah, if you're a little bit off, it's probably not the end of the world. But then managing the trade is the other super important part. So 50% retracement is my entry, placing just a limit order there, and then boom, gets me in the trade. And just putting the order a little ahead of the 50, because if you stop right at the 50, the market needs to trade through your order to get a fill. So that's great. We get in the trend. Now, how do we stay in the trade and we're not just shaken out for a small measly gain? So I like to use a 2-point first target, or 2-point stop rather, on the ES, and a 3-point first target on half the position. So 2-point stop. Let's say you got, we'll just say 2 contracts, and 2-point for both of those contracts is the initial stop. And then one of those contracts has a 3-point first target. If I'm using 8 contracts, then I would just put a 2-point stop for the full 8 contracts, and then 4 of those 8, half the position, gets a first target of 3 points. And that way I can lock in some gain at a reasonable reward to risk at a reasonable profit target. 3 points is not a huge move in the ES, but you're not really going to get anywhere trying to scalp 2 or 3 ticks at a time. So this way I can lock in some gain, I can reduce my risk, and I can still have half of a position that I'm able to trail my stop. So if we go back to that same entry that we were just looking at, using a trail stop then, so you get in the trade at the 50, you have a 2-point stop that goes out on the trade, and then using a trail stop method, one of 3 approaches you can use. So the first option is to just draw up the next retracement and put your stop below that 60-18. And none of these trail stops are like tied to an automatic price movement, so I'm actually moving the stop manually. So you could draw up the next retracement and then put your stop below the 60-18. The one that I like to use the most is just trailing the next swing low. If I'm long, we come up here, make a little bit of a double top and pull back. Once you make a new high, then I can bring my stop up and put it under that swing low. You get a fast run up, market pulls back a little bit, and then moves higher yet again. I can move my stop underneath that next swing low and continue to do that until we come down and break, what do you know, a swing low where we have a potential trend change. And so that's pretty much the best way I've found to manage positions in a hands-off way, but very structured. And it really doesn't matter if you're managing a swing trade on a daily chart or managing an intraday ES trade. Trailing swing highs and swing lows is a super effective way to get the most out of the position while still giving it room to run. And so, just putting your stop 2 ticks below is just fine. If we start going gangbusters crazy and you go really, really fast, you're going straight up, all of a sudden you're 10 points of profit and your stop is 10 points away from where price is. Option 3 that I like to use is to trail each candle. And this is something I'll do more on a daily chart, but intraday, if we get moving fast, rather than just hitting the flatten button to close out of the whole position or being scared of what to do, you can just drag your stop up underneath each candle. And sometimes you get 2 or 3 candles forming, it's going so fast you can barely drag it up underneath the most recent candle. But if you just do your best, that will keep you in the trade much longer than just, like I said, hitting flatten or trying to close out of the position and then making a mistake that ends up costing you. So those are the 3 main approaches that I like to use for trailing, and that trailing of swing highs and swing lows is really the most effective way I've found. And if you pair that with a reasonable first target, something like 1.5 to 1 of a reward to risk ratio, 2-point stop, 3-point first target, you get the sort of quick win. You free up some of your risk. At the time that I get that first target hit, I'm also moving my stop to break even because the trade's gone in my way a fair bit. And so now you can sit back in a very clear head and you know exactly how you're going to manage that trade. A lot of people like to, it's great to have a stop in place and you really don't have to do anything to get your stop hit, just the trade has to go against you. But if you have a trail stop approach for what you're going to do when the trade goes in your favor, you are positioned for those big winners. All you have to do is let them develop and not scare yourself out by exiting too early or saying, well, the trade came one tick away from my initial stop. When it gets back to break even, I'm just going to close out. You got to be comfortable with your full stop out, accept that before you get into the trade, and then let the trade work, let it do its thing. So to kind of tie all these things together here, looking at that tick chart paired with the hakanashi really helps get a nice visual of the chart and what's happening on the chart on a small time frame. You can identify the trend so that you can better identify where the trend is changing, and that's really the key, identifying where that trend is likely to change. And then entering at the start of a new trend, or sometimes if the market is pulling back, we might be pulling back to a larger support level. And so looking at where are some general support and resistance areas. Don't have to do any super in-depth analysis, just looking at where we traded in the past. And if those prior highs are coming back into play, you might see some resistance. Or if we've already broken out, you might see some support then if we're coming back down to those prior highs. So looking to enter at the 50% retracement. And then as far as trade management goes, I'm just using a 3-point first target and then trailing, and that's on half of the position, and then trailing the second half of the position most of the time by trailing swing lows and swing highs as the position goes in my favor. If you are trying to be super micromanagey of the trade while you're in it, you make one decision and you say, well, it looks toppy here, I'm going to close the whole thing out. And what does it do? It turns into a huge runner. So then the next trade you say, oh, I'm going to let this guy run because that last trade that ran for 15 points and I was sitting on the sidelines. So then you let it run. What does it do? It goes 4 points and then reverses. So this way you don't have to be playing that what happened in the last trade game and sort of being on your back foot the whole time. This way you're you're setting up in a very sound offensive means of having a first target and a trail stop in place. So if you have questions, you can reach me there at my email's on the screen, tim@eminimind.com. Happy to talk trading or bikes or anything else. I want to thank everyone for tuning in this afternoon, and I hope everyone has a great evening and great rest of your week of trading.